Good morning, venture capital. This is Metagame, and today we're chasing the $2 billion semiconductor bet that slipped past everyone's radar. While everyone was busy refreshing their feeds for the next OpenAI headline, $100 million was moving quietly through the SEC filing system. Then another $100 million. Then $2 billion. Then $4 billion. Nobody wrote about it. Nobody tweeted the thread. The question I want you sitting with for the next 10 minutes is this. What does it mean when the most important capital deployment of the quarter happens in complete silence? Here is what Q1 looked like from 30,000 feet. $300 billion in global venture capital. 4 companies, OpenAI, Anthropic, xAI, Waymo, absorbed 65% of it. One round alone, OpenAI's came in at $122 billion. That number is so large, it functionally broke the narrative. Every analyst, every LP letter, every podcast spent Q1 doing the same thing, staring at the sun. And while they were staring, the SEC Form D tape was filling up. 1,003 deals, $256.1 billion in disclosed capital. Strip out the 41 mega deals above $1 billion. Those captured $193 billion, 76% of everything, and you're left with 962 transactions dividing roughly $63 billion. The median deal size was $27.6 million. The average was $255.4 million. That gap is not math. That gap is where the real market lives. Let me break this down. The SEC Form D is a disclosure you file when you raise private capital. It tells you the company name, the state of incorporation, the total offering amount, and almost nothing else. No pitch deck, no sector tag, no press release. When the SEC logs something under other technology, that is their way of saying they have no idea what this company actually does. It is the junk drawer of categories. In Q1, that junk drawer had north of $4.3 billion in it across 8 companies, and nobody said a word. Back to the story. The largest non-headline filing in the entire quarter was Marvell Technology at $2.03 billion. $2 billion into custom silicon and data center interconnect infrastructure, and it landed with the media coverage of a regional zoning board meeting. Here is why that number matters. Hyperscaler capital expenditure for this year is projected at $675 billion. Every dollar of that $675 billion needs chips that are not NVIDIA's. Marvell is building for that gap. That is the picks and shovels trade at institutional scale, and it filed quietly in Q1 while everyone was doing the math on Sam Altman's round. Next on the tape, MatX at $530 million. MatX builds AI inference chips optimized for transformer workloads. Here's the problem they are solving. Hyperscalers have poured enormous capital into training infrastructure. Training is the sexy part. Inference, actually running the model at scale for enterprise customers, is where the economics fall apart. Cost per token is the primary bottleneck for enterprise AI deployment right now, and nobody has cracked it cleanly. A purpose-built inference chip company raising $530 million in Q1 is a direct institutional bet that the inference layer is contested territory, not a commodity NVIDIA gets to own by default. Then you have 2 separate $440 million filings in the same quarter for ML development tooling. Legora and Lightning AI are both at $440 million. 2 companies, same check size, same quarter, same thesis. The platform layer for building and deploying models outside of hyperscaler environments is not consolidated. Lightning AI, the company behind PyTorch Lightning, serves practitioners who are building real workflows without unlimited cloud budgets. A $440 million raise into that segment is institutional conviction that enterprise ML requires purpose-built tooling, not just API access to a frontier model. Crunchbase confirmed the read. AI and ML early stage, deal count rose year over year in Q1, even as dollar concentration moved violently to the top. Snowflake filed at $380 million, data infrastructure. And before you ask why a data platform raise belongs in the same conversation as inference chips and ML tooling, consider this. MIT put the enterprise AI pilot failure rate at 95% in Q1, 95. When you dig into why pilots fail, the answer is almost never the model. The answer is data quality, data access, and data governance, the exact layers Snowflake addresses. A $380 million raise into the data layer is a wager that enterprise AI adoption creates durable demand for data infrastructure, regardless of which frontier model wins the next benchmark. That is a very comfortable bet. Mercor at $330 million. This one is different and worth slowing down for. Mercor is building AI-native infrastructure for technical hiring. KPMG's Q1 data shows 62% of enterprises report a skills gap as a barrier to AI deployment. 62%. The bottleneck is not the model. The bottleneck is the humans who can actually integrate it into real workflows. NEA called this out explicitly. Forward-deployed product work and workflow depth are where moats get built. Mercor is positioned at the exact constraint that is slowing enterprise AI ROI across the market. That is not a niche play. That is a second-order infrastructure bet on the AI market itself. Then the bench gets deeper. D-Wave Quantum at $270 million, the largest quantum raise visible in the Q1 tape, positioning D-Wave at the frontier of near-term optimization applications. Oxide Computer at $180 million, building rack-scale cloud infrastructure for on-premises enterprise deployments. And KPMG's data shows 80% of enterprises cite cybersecurity as a barrier to AI deployment. Oxide's entire value proposition is inference on your own hardware, your own network, your own security perimeter. Span.ao at $160 million in intelligent energy infrastructure, which starts to look less like a niche bet and more like critical path when you understand that data center power consumption is now a first-order constraint on AI scaling. 8 companies, $4.3 billion, 0 mainstream coverage. Now let me give you the competitive frame, because this is where it gets uncomfortable if you are an allocator who spent Q1 watching the mega round scoreboard. You cannot buy OpenAI, not at any price your LPs would approve, not at any valuation that leaves room for return. The $122 billion round is not an opportunity. It is a data point. What it tells you is that the frontier model layer is priced. Done. The question for every allocator with a 5 to 7 year horizon is what is not priced yet. The Q1 stealth tape answers that question. MatX and Marvell are priced against execution risk on a product roadmap, not frontier model dominance. Oxide is priced against enterprise adoption curves, not hyperscaler CapEx projections. Mercor is priced against a skills gap that 62% of enterprises are already reporting. These are not speculative bets on which AI company wins. These are infrastructure bets on the fact that the AI market keeps growing regardless of who wins. Redpoint's data makes the rotation explicit. Vertical SaaS up 3%, horizontal SaaS down 35%. The rotation is not theoretical. It showed up in 8 SEC filings before anyone wrote a headline. And here's the part that should keep you up at night if you missed it. The SEC Form D database is public. Every allocator with a Bloomberg terminal and a paralegal can see the same 1,003 deals. The edge is not access. The edge is interpretation speed. The firms that mapped this cohort in Q1 are now 5 months into diligence on companies that have not issued a press release. That is the moat. And it is already being dug. Which brings me back to where we started. While everyone was staring at the OpenAI number, and it is a remarkable number, I am not going to pretend otherwise, $4.3 billion moved through the SEC tape into the companies that OpenAI, Anthropic, and every enterprise AI deployment actually depend on. Inference chips, ML tooling, data infrastructure, on-premises compute, talent sourcing, energy infrastructure. You cannot buy the frontier. You can buy the companies the frontier cannot operate without. Q1's SEC tape was the shopping list. The question is whether you were reading it or refreshing your feed. The next tape drops in a few weeks. What are you going to do differently? That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.